All right. Hello, everybody. Thank you for joining us this morning. My name is Doran, founder with Quantive, investment banker in the lower middle market space, working mostly in the GovCon technology space. I'm joined here with a few illustrious guests, which my colleague Dean Nordlinger will introduce. And today we're going to be talking about strategic choices for growth in a successful M&A exit. So with that said, Dean, you want to kick us off here?
Absolutely, Dan, thanks. Dean Nordlinger with Blank Rome. We're a full service law firm serving middle market companies, especially in the GovCon space. Been doing this for 20 years, representing companies through their life cycle, start to exit. Spent a lot of time working with clients on buy side and sell side M&A, again in the ADG space. And really glad that we are joined today by two individuals, both of whom are highly experienced in the government contracting space, both of whom are also very well embedded in the GovCon ecosystem in their various roles as founders, owners, and executives whose roots are in small business government contracting. They have respectively successfully operated their GovCon companies beyond small and traversed the chasm from small business to full and open territory. And again, glad to have them here today, especially with the way the market has been so robust and dynamic the last couple of years. So with that said, Mehul and Damon, respectively, would you guys please take a moment to introduce yourselves?
Sure. I'll start. Mehul Sanghani, CEO and founder of Octo. We are a mid-tier government contractor focused on providing next generation technology and modernization solutions to the federal government.
Hi, I'm Damon Griggs, CEO of Dovel Technologies. We're similar to Mehul, mid-size government contractor, high-end technology capabilities, focused on the federal, health, and adjacent civilian markets. And we were just acquired by a Guidehouse last quarter.
Awesome. Thank you, gentlemen. So where I'd like to start, for the first question here, both of your companies started as small business, sort of the typical lifestyle family-owned business. Mehul, if I understand correctly, you were a 8.8 graduate, and Damon, the company you run is formerly a woman-owned small business, and both have grown materially since then. So the question I'd like to pose is, what are some of the factors and thought process that went into sort of graduating you out of that small business and away from the lifestyle company into full and open unrestricted market and sort of the mid-market companies that you're at now? And Damon, maybe we'll start with you.
Sure. So I joined Dovel in 2016. So I really want to give full credit to the founders, Dov and Elma Levy, and my predecessor, CEO Paul Leslie, for really coming up with the initial strategy and for their commitment to reinvest everything they had into the business. Obviously, there's different ways you can run small businesses, as you said, as a lifestyle company, or you can really run it as you're putting everything and you're reinvesting in the company and you're building long-term value that will ultimately be recognized later, but theoretically at a much higher rate of return. And they took very modest pay, even took some cuts during difficult times and sequestration or government shutdowns and other things, and really put the company in a position to be able to make some of these acquisitions early on, and off of the company's own balance sheet. So taking on debt to do our first several acquisitions and get us to the point where we were able to, by the time I joined, beginning in 2016, Dovel was already over $70 million run rate and had successfully graduated. Still had some legacy small business set aside work, but we're shedding it quickly, and we were able to continue to grow exponentially since then. We acquired MSC in 2016, and then in May of 2019, we made the decision to we kind of hit our limit in terms of what we could do internally. We made the decision to take on a private equity partner, and that was Macquarie Capital, and that really infused us with all sorts of additional capital to not only invest in the next phase of growth in terms of innovation and a leadership team that was really built to scale for the future, but also do another large acquisition of Ace Info Solutions later in 2019, which ended up being incredibly successful and gave us a lot of the additional capabilities, contract vehicles, and other key capabilities that we were looking to do and from a customer perspective. And as a result, we continue to grow. I think we grew 50% in the 2 years following the Asimpo acquisition. I think we've had an average growth rate of about 40% over the last 5 years. And over half of that was organic, but the other half, which was key, is the inorganic, and that got us on a run rate of about $450 million this year, which ultimately led to being noticed in the market, which is a very hot market, and our eventual sale to Guidehouse at the end of 2021.
Awesome.
So,
Mehul, how about you? Sorry.
Yeah, great. Yeah, no, I founded. I was fortunate enough to found the company in 2006, and one of the things that I'm quite proud of, and I think one of the things that really allowed us to have some success in our growth and our trajectory is that we really focused on differentiating the company around technology. And a lot of the terms or the jargon in the marketplace that is commonplace now, capabilities like agile software development and cloud. These were nascent capabilities when I founded the firm back in 2006, but areas that we really wanted to carve out our niche and our specialization in. And so we were fortunate, I think, in some ways, to catch lightning in a bottle. I think those were capabilities that we gravitated to and built our niche and our reputation around. But also, coincidentally, those were areas of significant demand aperture in the marketplace. And so, that's what really drove the growth of Octo, is the fact that we were at the intersection of not only specializing in those capabilities, but also having significant demand for those types of modernization capabilities take off from 2006. And so I would say from 2006 to 2015, we really rode, that tidal wave of not just demand aperture, but our focus around that horizontal differentiation and those capabilities. And we were able to navigate what I consider the major inflection points for a small business. We were able to gravitate towards, that $10 million inflection point, which a lot of small businesses, I think, really struggle with in terms of building an identity, and then 10 to 25 million. And I think the last inflection point I'll point out was, from 25 to 50. And at each inflection point as a founder, you really have to, do some gut checking, because each inflection point, even those inflection points that I denoted, 10, 25, 50, require substantial reinvestment in the ongoing operations of the business to be successful. One of the other things, and you noted, our roots, in the 8A, one of the other things that, I think we were deliberate about, but I think, in hindsight was very good for us, is that we never really relied on that socioeconomic status to be part of our differentiation. We did enter the 8A program, but we voluntarily withdrew within a year, for a number of reasons. I think there's, significant, reporting requirements. And then I think at a certain point, we didn't feel we met, or before SBA told us we didn't meet, some of the economic disadvantage criteria that program warranted. And just my own personal perspective, I think in some ways, as we look to partner, as we look to build our brand identity around those capabilities that I talked about, it becomes a little bit of an albatross. It becomes a stigma. I think folks view that your differentiation is tied to your socioeconomic status rather than the capabilities that we really were striving to be differentiated around. And then in certain cases, some of the customer intimacy that we were starting to build. And so, that was that 10-year period. But to sort of fast forward, the other thing that we did once we kind of hit 50 million is I had a conversation with a banker like yourself. And one of the things that he said really stuck with me. And he said, you really kind of have two choices in terms of, where you're at. You can continue to run your business like a lifestyle business and run it like an ATM machine, or you have the intestinal fortitude to take, some or almost all of the profits that you've made heretofore and significantly reinvest in the business, because this last chasm, even at 50 million in size, you really have to you're going straight from being, on your 5-year look back, from being a $50 million business competing directly with multi-billion-dollar enterprises. And so, that takes not only infrastructure, that takes capability, that takes a lot of things. And you have to make that decision, because there's nothing, I think a lot of folks look to sell their business, but there's nothing wrong with having a lifestyle business. It can be very lucrative, in many cases more lucrative, depending on how you're positioned, than, really trying to double down. But we looked to double down, and I was fortunate to hire a gentleman named Bob McCord as my president and COO. And Bob not only brought maturity and and experience, but certainly the discipline. He had navigated that chasm before, so he brought a level of process discipline and infrastructure discipline, and a business development discipline that certainly in some in pockets we had, but certainly weren't congealed enough to be able to make that leap and cross that chasm. And so I was fortunate to have him by my side for 4 years prior to our partnership with Arlington, at which point he decided to take some time off. But that 4-year period where we really significantly reinvested in building our infrastructure, building out more capabilities, allowed us to cross that chasm from 50 to around the 130 to 140 million in size. And that was where we also crossed the chasm in changing our overall contract mix. We were a company that was predominantly 100% small business set aside, around that 215 timeframe. To the time that we transacted, we were a company that was predominantly almost all of our work was unrestricted. And that takes a lot of wins in order to do. If you're a company of a certain size, for example, if you're 50 million in size, if you want to be a company that's 70% full and open, I don't think folks appreciate the amount of full and open work that you actually have to win to get to that level of contract mix. You have to win, several $100 million worth of awards just to get there. And so we were fortunate enough to do that. And I think fortunate enough to have, Bob's wisdom and advice helping guide us along the way. But, I'll pause there, but those are some of the key things that we looked at as we made that leap.
So, okay, that's very insightful and detailed. I like that. So I want to stay on the topic of, we all know that companies grow two ways. You touched on it. Well, you can grow inorganically or you can grow organically. And thinking back, I just want to back the truck up a little bit, going back to when you were smaller and you were going to go along the spectrum. I want to talk about, I'll go with Damon first and then back to you, Mehul. Talk about how you used your organic strategy to fuel your inorganic strategy, both in terms of, primarily in terms of how you then looked at, hey, is there somebody we could acquire, and or how we're going to get a third party interested to believe that they should invest in or acquire us?
So the organic, and I said this in the prior session, organic growth is by far the most cost-effective way to grow, and certainly the builds the most long-term value. But there's a time and a place for inorganic, and especially when you want to enter a new market rapidly, develop, acquire new technology quickly, things like that. And so I think Dovel really started off focusing on the organic side and had several years of strong organic growth to get it to, it's sort of that nascent stage where it could do a couple smaller acquisitions on its own balance sheet, as I mentioned earlier. And then that kind of fueled a lot of the future growth. We did the MSC acquisition, like I said, in 2016. That got us into the real, we were well over 100 million at that point. I'm closing in on 200 million, and that's when we attracted interest from private equity. And really, that's when we sort of hit our limit in terms of what we could do on our own balance sheet. So that next phase is really where we were able to kind of accelerate even more once we got the infusion from Macquarie Capital to do all the investments. That's the nice thing about kind of hitting that mid-tier size is we still look and feel, and I always talk about Dovel and Mehul may feel the same way with Octo. It really was in a lot of ways the best of both worlds, because we still look and felt like a small company where it mattered in terms of customer focus, agility, responsiveness, the entrepreneurial culture. But we actually now had scale, and we had a much broader set of capabilities, and we also had enough investment to make more than one bet at a time. And when you're small, you got to place your bets very selectively. You're lucky if you can make one investment at a time, and you hope it pays off. We were able to make multiple investments. We invested a lot in innovation. We invested a lot in our leadership team, and we also did the Asinfo acquisition. So we were able to really pursue a multi-pronged strategy to grow on all fronts and really build true enterprise value. And even when I talk about innovation, we developed several patents. We had proprietary tools that we embedded into our solutions for our customers that really helped us, become stickier with our customers and winning recompetes. So it all kind of starts to really build on itself when you hit a certain size where you can really invest across multiple facets of the business.
Got it. Thanks. Mehul?
Yeah, so I'll try and pick up a little bit where I left off. When I talked about, a key inflection point for us being that time period between 2015 and 19 and being able to cross that chasm, into full and open. And so what really allowed us to be able to do that, I noted, the fact that we needed to win a significant amount of full and open business, was the fact that, from a strategic perspective, we had built a brand identity. We had built, reputational credibility around, these areas of modernization capability, agile software development, cloud engineering, user experience and design, cyber, some of these areas that were core to major modernization efforts. And so one of the things that we looked at is if we're going to be punching up in weight class and we are going to, have to compete for full and open work, where are we going to be the most successful? And for us, as Damon pointed out, you can't, at that size, certainly you can't place bets everywhere, but a core tenet of our strategy was taking advantage, of our reputational credibility and looking at opportunities that were major modernization efforts, regardless of agency. And so, again, I think a lot of small businesses that have had, significant growth trajectories have done so with intimacy and a focus on a specific market. We did so, and we had our growth and our success with horizontal differentiation, identifying opportunities, be they at HHS or in the intelligence community or in, some of our defense combatant commands, where folks were demanding, a provider that not only had, next generation capability, but brought something that the larger players didn't, whether it be IP, or specific expertise in doing cloud native development, taking things that were complex mission centric applications and then moving them across multiple security postures, which we did in some areas of the intel community. We looked at, and we not only were able to get in on the front end of those opportunities and sell them on our credibility, but we were able to talk to them at length about what our solutions and value propositions would be long before, the RFP is released. And so nothing I'm talking about here is, a silver bullet. These are things, capture, discipline, that are commonplace in other conversations. But I think it's that discipline combined with our focus on horizontal differentiation and picking selectively the right opportunities where folks were desiring that allowed us to have the degree of success winning, beating out larger competitors for full and open opportunities, being an insurgent bidder where folks were looking to modernize and their approach from what they had from just keeping the lights on to really, modernizing what they were doing in the next iteration of solicitation. Identifying those opportunities was key to our organic growth and success. And so, fast forward to 2019, we had an opportunity to exit completely. We had a number of different strategic, publicly traded suitors that were interested in acquiring us. But we instead, we really believed in our strategy, and we felt that our painting was not really finished. And so we decided to partner with Arlington. And with Arlington, we not only were able to take advantage of, that organic strategy and sort of that differentiation, but we were really able to double down on that. We were able to look at inorganic acquisitions that brought additional capabilities that we felt were going to be tip of the spear for Demand Aperture going forward. Artificial intelligence, machine learning, open source software development, common data fabric. These are things that we were able to attack, not just with our own internal R&D investment, but also attack selectively with M&A catalysts to add to our differentiation and story. And so, that's really where you see the intersection of, not just some of the things that we laid the groundwork for organically, but also where we were able to selectively look at M&A catalysts to continue to position the firm as a differentiated asset.
Great.
So great segue. I kind of wanted to talk about where you're going with this, Mehul. Many founders go down this route of, I'm building a company eventually to sell, especially in the federal space, sort of the built to sell mentality. Both companies here today went through a private equity recapitalization prior to a full transaction, at least in Damon's example here. But one of the things that I see a lot is founders are reluctant to give up an element of control. And oftentimes they view this as an all or nothing. I want to sell completely to a strategic, or I want to maintain, complete ownership in this company. I'd be interested in hearing the thought process of why you decided to go down the recap private equity investment route and what made the timing right for you. So maybe, Mehul, let's start with you, and then we'll flip this back over to Damon and talk a little bit further about the experience at Dovel.
Yeah, no, and I'm glad you brought this up. I think these sorts of decisions, as you might expect, certainly for a founder like myself that, founded the company on its own, on my own, these are deeply personal decisions. These are, not only you get emotionally invested, these things. I mean, I think the cliche is to refer to it as your baby, but, really they're obviously a lot of parallels, and each decision that a founder takes is deeply personal. There's no wrong decision, when it comes to, an enterprise that you've built and cultivated in that regard. And it was no different for me. I think, as I noted, I think, we, around the 2019 inflection point that I talked about, we started to receive, significant interest from, strategic acquirers. And I think, like many others, I think we were purposeful and we weren't necessarily built to sell. We were very methodical in thinking about how we might get there and whether that was the right decision for us, whether it was the ATM or being built to sell. And we did that. And I think we were at a point where we could have achieved that. But in many ways, I think we all felt that we weren't, as I noted, we weren't really done. If it was Michelangelo, we weren't really done with our painting here. And there was significant upside still left in the business. And I really viewed, our trajectory in terms of inflection points. I talked about it going from 10 to 25 to 50. And I thought the last sort of tranche for us would be around that $130 million size, because I think at that point, you really have to look at, I think, M&A to be successful. And as I noted before, I think to be credible from an M&A perspective, even if you have the debt capacity, you have to have done that before. And I think as we went into those conversations with strategics, certainly there was an element of, okay, was I really ready to let go? But there was also an element of, hey, there's upside left in the business. And Arlington did a great job of really articulating the value proposition of hitting that next inflection point, that $500 million to $1 billion trajectory, and doing so selectively with M&A and really doubling down on some of the things that had been successful for us. So that was, a key element. I think they really sold us on that, but it also fit for myself and the leadership team. I think demographically, spiritually, we were all not ready to sort of hang up the cleats in that regard. And I think that's an important element there too. So it's not, but the last thing I'll say is that it's not just about being spiritually aligned. As you noted, there is, for a founder, you have to be ready to be a true partner with someone else. I think in many cases, especially cases like mine, where you have a single founder, there is a cult of personality. And I think this element of, in many cases, an autocratic leadership style. When you're part of a shared governance environment, especially a shared governance environment where you've ceded majority control, like I have, you really, and there's certain, don't get it twisted. There's certainly an element of that vetting that goes on by the PE as well. Do you have the personality that can, be part of a shared governance structure, a shared level of accountability, working with a board, working within that discipline, where you're not necessarily the only stakeholder and not necessarily making every major strategic decision autonomously involved in the firm. And so I think that's a gut check, for any founder, if they do consider, the private equity route. It's that in and of itself is also not a panacea. You have to have a self-awareness to know and understand whether you can truly operate in a shared governance model. And many founders cannot, just because they've operated autonomously for such a long period of time.
Awesome. Thank you, Mehul. Damon, thoughts from you?
Yeah, so again, full credit for this decision to Dov and Elma Levy and the co-founders and Paul Leslie, the CEO at the time, for really believing in our strategy and believing in the path that we saw to get to the 500 million to $1 billion range within the next several years, just pursuing and executing on the strategy that we had laid out. So part of it was that we really believed in the runway that we had. We just needed additional capital from outside to get there. Part of it too was belief in our leadership team, and that we really wanted to keep that team together. A lot of the key folks, and then one of the other big components, and this is again a tribute to the founders and really the culture that we have at Dovel, how customer focused it is we were really worried about letting our customers down. The customers have really appreciated what we were offering for them, how much control they had, how they could go right to the top of our company whenever they had an issue, and how responsive we were. And we didn't want to risk that to going the strategic route. And again, at least at that time, and these days, valuations are getting closer and closer, and PEs are even paying up above strategics. But at that point, strategics were still paying, typically paying a little bit more of a premium than PEs. So they left some money on the table to really, let things continue to roll, to execute on our strategy. And it definitely did pay off later for everyone at that next bite, or maybe it was a whole nother apple, depending on how you define it.
Awesome. Thank you.
So taking all that into account, and given that, again, we've talked about the fact that both of you were successful in taking firms with small business roots and transcending, and so you've been on the sell side, and you've also been on the buy side. So when we talk about exiting, right, I feel like there's always three questions that come up. How saleable is the company? What are the target company's value drivers? And as a buyer, within all that, how are you viewing and valuing any small business set aside legacy type work that's there? So I would like to hear from both of you. And again, we all know through this dialogue that you were able to hit a high note on all three of those as sellers. But could you talk to us in the context of when you went through the process as a seller, and what your mindset has been on the buy side? And I'll start with you, Mehul.
Yeah, sure. And so I think, Damon has talked about sort of the 5 C's that you look at. I think obviously, we look at, those foundational elements, from a buyer perspective as well. What are, the key customers, what are the contract vehicles, and then what are the capabilities, that a prospective seller is going to be able to bring to the table and add to the mix. And so, we have, again, when we look at how we position ourselves, in much the same way. I think, every company has different approaches to how they've differentiated. As I've noted, I think we've differentiated, based upon, trying to be a pure play modernization provider and bringing some of those capabilities to bear. And so in looking at M&A, we've looked at things that grow and enhance, those sorts of things. But, separately, we've looked at things that bring insular customers. If you look at both the Connexa and the Volent deals that we've done, they not only brought unique open source capabilities in the case of Connexa, common data fabric, open source capabilities in the form of Volent, but they also brought insular customers. Connexa brought, and doubled down on our presence at the NGA, and Volent really doubled down on our presence in a couple of select Intel communities at DIA and NRO. So insular customers are a part of it. Here more recently, we're fortunate to complete, the B3 acquisition. They not only brought differentiated capability in sort of low code, no code, platform as a service type capabilities, things that our customers are demanding now, and Salesforce and ServiceNow, really differentiated capability that is difficult to build organically, difficult to attract a critical mass of talent and build that capability organically. But separate from the capabilities, they also brought a vehicle in the form of T4NG and brought, an insular customer in the form of the VA. And then previously with Sevitech, we, really saw a company that looked much like us, from a capability and differentiation perspective, but they really brought an elusive customer for us and a significant franchise position, at DHS, which was an elusive market for us and really allowed us to establish, not just a beachhead, but, as I noted, a franchise position there. So, capabilities, customer intimacy, and then contract vehicles are some of the dimensions that not only, we built our firm around, but separately the same lens that we look at when we look at, potential acquisition targets too.
Got it. Appreciate that. Damon?
Yeah, and drilling down a little bit more specifically into the small business risk side of the question, because I think Mehul handled the rest of those the same way I would have. I feel like, maybe a few years ago, buyers were very risk averse around any small business they would immediately shy away from or heavily discount. As this last year, especially, the market's gotten hotter. Buyers have to be willing to take on more risk, really look at that small business profile and dig a little deeper to see what's in it and how convertible some of it may be to full and open down the road. And so we did that as well. And Ace Info actually had some small business set aside risk. But what made us feel more comfortable about it when we did that deal, and this was true with Dovel. So we were actually able to convert a lot of our legacy small business work into full and open, is these are long-term customer relationships that they were small business contracts that started off relatively small, but had grown exponentially over time, not just in terms of size, but also in terms of complexity. And if you see programs like that, the odds of it, you being able to convert it to full and open are a lot higher, because the switching costs are really big to a customer. That if you've proven yourself to that customer long-term, you've grown with them, it's complex work that you're performing. It's hard to just award that to someone else and assume you can just kind of flip some of the team and still deliver at that same level. And we saw some of that. So if you have small business work, if you're looking at a potential target that has very diversified, a bunch of different small business contracts that are all very small, that's risky. If you have a couple relatively concentrated, larger small business contracts that have grown over time that are still classified as small business, that's less risky to me. And the potential of converting that is a lot higher. And we've lived that on the Dovel side, and that's what created a lot of the value in our process. And we've seen that the same now. But another factor you also need to consider is political factors as well. So what administration, how small business friendly or not are they? Maybe the likelihood of converting work from small business to full and open a couple of years ago is different than it is today, even if all the other factors are the same, just given new administration, new priorities, and focus on small business set aside work and hitting those goals. So all that has to come into play as you're factoring it, in addition to the 5 C's that we both talked about in the prior session.
Got it. Thank you. Really
important. I mean, just to piggyback on that too, real quick, because I didn't address it, but like I echo all of Damon's sentiments, but quickly, I mean, I think you also have to be able to handicap, with each individual target, their ability to really make that transition. Certainly as Damon noted, the market's hot. There's certainly, you have to take on more risk, and there's more receptivity in general for small business transition risk. But I think really digging into the details and understanding, whether there is the ability to transition those contracts. And oftentimes what we rely on is precedent. Is there precedent, as, Damon pointed, not just, at the macro level within the administration, is there precedent within the agency, or is there precedent certainly within the firm that you're looking at as the target? Have they demonstrated the ability to transition other contracts? I think using that as a little bit of a litmus test to foreshadow whether those contracts that remain in small business programs can transition.
Great.
Awesome. So final question to wrap this up and put a bow on it. We'll stick with Damon first here. and then flip it back to Mehul. Words of wisdom. So if you are a founder working through this growth curve, like we've been talking through today, suggestions on how they might approach this thought process on access to capital markets, private capital markets, or full exit. Ideas on what they should be thinking. Damon, you first.
Yeah, it's a broad question. I think first and foremost, what if they're considering selling, certainly get their house in order. You want to be prepared for all the diligence, the process, the types of questions you're going to get. You also really want to think about what your role is. Depending on, as Mehul said, do you want to still maintain some type of control? Do you want to maintain full control and maybe have more of a growth equity type investment? Do you want to bring in a controlling interest? Do you want to sell to a strategic and completely hand over the reins? There's many different factors at play, and each, it's personal preference. Some of it may depend on where you are in your stage in your career, but all that has to come into play. And really, I think just focusing on building true value drivers to maximize the outcome, whatever result you want, whether it's minority control, majority, or full sale. You want to maximize whatever that exit value is, and a lot of that depends on not just having the most attractive customer base, contract vehicles. They're gonna want to look at your some of the intangibles. How engaged are your employees? What are things like Glassdoor ratings look like, or other things that that you might not think really matter when it comes down to it, but in a competitive process, those will factor in. Making sure that you're taking opportunities to invest in innovation and additional proprietary tools that you can maybe embed into your solutions for your customers to make sure you're winning that next recompete, and making you stickier with your customers, and because buyers are going to come in and look at your recompete win rates, and a lot of what Mehul said, they're going to look at, is there a track record there converting small business to full and open? How deep and far back do your customer relationships go? What do your CPARs look like? All those things. You got to start thinking ahead now and be prepared to have, for a full inspection. And if you don't like what they're going to find, then maybe you're not ready.
Awesome. Mehul, thoughts from you?
No, I definitely, I think, David did a great job of explaining some of the tactical elements that and I'll speak certainly from a founder perspective, but, you as an owner or as a founder, if it's multiple founders, really have to be prepared for, prior to an exit. And I think there are no shortage of good advisors in our market, ones that specialize and know and understand the nuances of our market. And so I really recommend, or foot stomp some of the things that Damon talked about, which is, getting your internal house in order, but also, aligning with the right partnership so that you can get good, no BS advice about where you really stand. And, I think, oftentimes I think folks, as founders or owners want to time the market. Obviously, we've alluded to the fact that the market's hot, but do you really have, a saleable asset? How will the market react to the asset that you're putting out there? A hot market sometimes also means it's a crowded market. There are other competing assets that are out there, and, valuation and expectations certainly have gone up. And so how does the asset that you have, what is the true market value, for an asset like yours against other assets that might be available at the same time? So all of these things, really are predicated on getting the right sound advice, both legal, investment banking, and then internally, having, I think if you don't have folks within your firm that have gone through a process or a transaction before, certainly there are no shortage of folks that are semi-retired that will serve as advisors to really help you navigate that. I think there's also an underestimation on the tax that it places on your internal back office as well, whether it be HR or finance. And so, that tax, along with, the fact that in many cases founders take for granted, that Maslow and, how they might be feeling about what happens on the other end of the transaction, can lead to a lot of choppiness throughout the course of a transaction or a process. So there's a number of really complicated elements of blocking and tackling that I think people can certainly take for granted going to exit. But lastly, I think some of the other things that I talked about were spiritual. You really have to, as a founder or set of founders, really have to have a spiritual understanding of what you want. And I think, what do you want out of an acquisition? Are you really ready to see control? What are you looking for in an acquirer? What, in terms of the resources that you've invested, time and energy in cultivating this legacy with shoulder to shoulder, what do you want for them? How do you want to communicate and articulate what's happening to them? And so if you don't go into it with, sort of that spiritual zen or being at peace with exactly what you are looking for out of the other end of the transaction, what you're willing to do. I noted, going into it with a PE requires, a level of seeding control and having the self-awareness that you're capable of doing that. Right. These are all things that really have to heavily factor in spiritually, in addition to all the things that go into it tactically too.
That's great. I think, as Dan and I listen to you guys drop wisdom here, I sort of inescapably come to the conclusion in terms of takeaway that you are unavoidably the product and the outcome of the decisions you make along the way. As you said, all of which are personal. And it feels to me like, hey, listen, there's no shame in it. There are some great lifestyle companies, but to be truly saleable, part of the decision making along the way is the choices you make and the things you do. What's going to be the end product of that? How are you going to be perceived by the potential buyer pool? Like, not yourself, how great do you think it is? More importantly, how do those third party, how are they going to see you? How are they going to find you? And obviously in both your cases, you did it up well, you did it up correctly, and you had successful exits. So really appreciate you guys taking the time to talk through all this with us. Very relevant, very timely. As you guys noted, the market is dynamic, it is robust. I don't think there's any reason to think that 2022 and the M&A cadence and rhythm is going to be much different than what it's been the last couple of years. And so I think there are a lot of people in the audience who are thinking about this, and I think that you've given them a lot to leverage and take forward on the path. So thank you for that.
Awesome. Thank you, gentlemen. Appreciate your time today.
All right. Thank you. This is great.
Thank you.